One of the most popular dividend stocks in history is the Coca-Cola Company, stock ticker KO, and it's really popular for a couple of different reasons. Now, the first is going to be that strong dividend history. This is a company that's been increasing dividend payouts for 60 consecutive years. That's pretty unbelievable. But the second reason is this is actually one of Warren Buffett's largest positions in his portfolio. It currently makes up around 7.63% of his entire portfolio, and he owns around 400 million shares. Now, the company is currently trading at around $60.45 per share, which gives him a starting dividend yield a little bit above 3%. We can see over the past year, the company's down about 1.45%, and year to date, down about 4%. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of Coca-Cola. We'll be looking at a few different valuation models like always. So if you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in the stock ticker KO and hit enter, and you can see all of this data will automatically load in. If we come here again, we can see that dividend yield currently sitting at around 3%, dividend payout of $1.84, but they have a payout ratio sitting at around 77.2%. That's typically a little bit higher than I like to see for the companies that I invest in. So let's go ahead and investigate that just a little bit more. If we jump back over to Seeking Alpha, which by the way, you can get a 14-day free trial to at my link in the description. But if we come here and click on dividend and then click on dividend safety again, you'll see the dividend payout ratio for the trailing 12 months sitting at around 77 or 78. And even if you look at the free cash flow payout ratio, it's sitting at around 70 to 71. So yes, that payout ratio is definitely a little bit higher than we'd like to see it. But if we scroll down a little bit more, basically you're going to see that's pretty much the standard for Coca-Cola these days. Over the last 5 years, the payout ratio has been as low as 70, but it's also been as high as around 85. Jumping back over to our spreadsheet again, you'll see the 20, 50, and 200-day moving averages all down a little bit. If we come down here, we can see analysts currently have a target price of around $70 per share. Institutional ownership sitting at around 71.5%. Now, something I definitely want to point out is that beta. The beta is sitting at only 0.55, meaning you'll see very little volatility with this company. As the market moves up and down quite a bit, this company should stay fairly stable. Now, the first valuation model that I typically look at is Graham's valuation, but for a company that trades at a premium like Coca-Cola, I really don't think it makes much sense to look at this valuation. So we're going to keep moving forward and look at our discounted cash flow analysis. And this is basically a way to value a company based on how much free cash flow it produces in the future. So what I did is I plugged in the historical free cash flow so we can see the year-over-year free cash flow growth rates. They had an average growth rate of around 4%, which is actually fairly low, which brings me to another point. This company is not projected to grow very much moving forward in the future. The free cash flow growth rates will likely be low and the dividend growth rates will likely be low, which brings me about to another point. I was actually doing some research and found that Warren Buffett hasn't added to this position since 2012. So it's been well over a decade since he added this to his portfolio. But jumping back over to our spreadsheet, you can see moving forward, even with a 6.5% free cash flow growth rate, we still come to an intrinsic value of around $46.04 with our discounted cash flow analysis. And this is a company that trades at a premium, which I'll talk about just a little bit more later in the video. Let's go ahead and keep moving forward and look at our multiples valuation. And the idea behind this is we should be able to value a company based on how the market is valuing companies that are similar in structure. So of course, we have PepsiCo and then we have Monster Beverage. We're taking their stock price, dividing by the earnings per share to find their price to earnings multiple. We then take the average price to earnings multiple, multiply by Coca-Cola's earnings per share, and we come to an intrinsic value of $87.40. Now you can see the average PE for these companies sitting pretty high at around 38.5. But if we jump back over to our stock screener, we can see Coca-Cola's price to earnings sitting at 26.63. So compared to its peers, it would appear it's a little bit undervalued. Now moving forward and looking at our dividend discount model, this valuation model values a company based on how much they pay out in dividends and how much that dividend is increasing. So I plugged in the quarterly dividend payouts over the last few years, so we can see how much they pay out each year, and we can see our year-over-year dividend growth rates. It looks like they've had dividend growth rates of 2.5, 2.4, 4.76, and 4.55. That's an average growth rate of around 3.56. So moving forward, I'm projecting a dividend growth rate of 3.75, discount rate of 8%, which gives them a dividend discount model price per share of around $45 per share. Now, I definitely can't project a high dividend growth rate in this scenario because, like we saw with our discounted cash flow analysis, their free cash flow growth rate is slowing, and we already saw that they do have a fairly high payout ratio. So for that dividend to stay safe, they definitely can't afford to continue to hike up that dividend at a high rate. But moving forward and looking at our output tab, we can see our three valuations that we use. We have multiples at 87.4, discounted cash flow at 46.04, and dividend discount model at 44.9. When we average those three together, we come to an intrinsic value of $59.45 per share. The current trading price currently sitting around $60.45, but with a 10% margin of safety, you can see our acceptable buy price sitting around $53.51, so it's not quite in our buy range. At a 20% margin of safety, your acceptable buy price is sitting at around $47.56. Now, this is undoubtedly a company that trades at a premium. Anytime you have a company like Coca-Cola, Microsoft, or Apple, a lot of the times you'll see the Warren Buffett effect come into play, but it's also a company that has such a strong history of dividend growth over such a long time period that people feel very confident in this company and its ability to continue to pay out dividends over long periods of time. And because of that, it becomes a very popular stock during periods of economic uncertainty or economic downturn. And because of that, it's very rare that you'll find opportunities to add companies like Coca-Cola way below their intrinsic value. Fortunately, if you were keeping up with this company during the pandemic, you were able to add at a pretty good share price, which is what I was able to do. You can see Coca-Cola currently makes up around 3% of my dividend portfolio, and if I blow up this growth chart right here, you can see I'm currently up around 27% on my Coca-Cola position. Now, one more thing that I did want to take note of is if we come back over here and click on valuation on Seeking Alpha, the price to earnings for this company is actually a little bit below its 5-year average. So compared to where the company's trade at historically, it would appear that maybe the company is slightly undervalued. But all in all, I pretty much agree with the headlines of this article. Coca-Cola definitely has its merits, but the upside is limited. Coca-Cola has very strong brand recognition, it has a really strong global reach, and it has a diversified product portfolio, and all those things give it a competitive advantage. But overall, there's just really not much growth projected for this company in the future. So if you're looking for a safe place to put your money where you can get safe and reliable and growing dividends, this is definitely a good option. But overall, this company will not be seeing much growth in the future, which is one of the reasons that I really haven't added this position in quite some time. I'm happy that I was able to buy in at around $47 or $48 per share, but I really haven't seen the company trading close to my acceptable buy range in quite some time. So there you go, there's a quick analysis on Coca-Cola Company. If you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.